been subject to ratings agency scrutiny, and tend to have an almost a congenital preference for higher quality investments and certainly principal preservation, which makes the current environment particularly challenging for them and therefore for us. Very briefly, I have been in the investment business for over 30 years. I've been in the markets personally for 35 or 40. I've worked for a couple of firms, and I am chief investment officer of our firm, and I've been there for about 25 years.
Please tell us then, from your perspective, where do you see the main challenges and opportunities when it comes to dealing with investment opportunity, but also with the risk and the risk of capital loss?
Well, our view, to make a very complicated subject perhaps more simple than it deserves to be, is that the financial crisis paradoxically raised risk levels rather than clarifying anything, confused investors rather than clarifying things. Oftentimes, crises serve as the sort of paroxysm that clears the air somehow and induces policymakers to take action that clarify how things will be handled in the future. The 2008-2009 global financial crisis had the opposite effect. There was no plan for the government acting as lender of last resort, and so you had the very haphazard approach when house prices started to roll. The Bear Stearns hedge funds got in trouble in the summer of 2007, that appeared to culminate in Bear Stearns, the Bear Stearns crisis in March of 2008. And the government employed the fairly conventional lender of last resort in orchestrating the Bear Stearns takeover by Morgan with the Maiden Lane deals. And in fact, the Federal Reserve, in their description of Maiden Lane 1, specifically invokes the section of the Federal Reserve Act that allows them to act in unusual and exigent circumstances, as the legislation says, in lending to private borrowers. And that was fairly conventional lender of last resort behavior. So far as that went, it appeared that government was following the script. And a side note here, the script is almost 200 years old. The development of lender of last resort doctrine really began in London with the Bank of England in the 19th century. And financial historians look at the financial crisis in London of 1825 as a seminal development, because it was the first time, the first real financial crisis after the Industrial Revolution in England, and the first time that a bank clearly acted as lender of last resort to keep the financial system solvent. And that was a lot of the thinking about that continued to develop through the 19th century. It was captured in a book called Lombard Street by Walter Bagehot in 1873, I believe it was. And this script, if you will, pretty much held until September of 2008, when the crisis became so severe and the public distrust of the financial system in the United States reached a crescendo, that because presumably of concerns about moral hazard, Lehman was allowed to fail. And that was a seminal event. We think that will be appreciated more as time goes on rather than less, as an event that really changed financial system behavior and attitudes toward risk. And specifically, the problem that the government has now is inducing people to take risk when they've learned that government behavior can be unpredictable and unreliable. And so inducing people to make risky investments, and by risky investments I don't mean investments far out on the surfboard, I mean typical private sector investment kind of decisions, corporate investment and so forth. Inducing them to do that when they've learned that there may not be a lender of last resort when things go wrong means that people are likely to employ less leverage, higher precautionary balances, and self-insure, essentially in insurance terms. we think that that's a change that's going to persist for some time. So our guess is that that the bear market in stocks is not over, and that until this repricing of risk is complete, that stocks will continue to struggle, both in nominal and real terms, and we'll continue to have a world of lower returns and at times considerable volatility, much more so than we're accustomed to. The paradox is that while we have this challenging environment for stocks in both nominal and real terms, certainly risk adjusted, we have two secular price increases underway, two secular bull markets underway, one in bonds and one in gold, precious metals. Those make very odd traveling companions and probably unsustainable traveling companions. One can make a case that stocks and bonds should travel together, which they did for the 20 years starting with Paul Volcker. You can even make a case that stocks and gold can travel together for a period of time, as we've just seen in Europe with the lifting of the fears of a deflationary policy mistake in Europe. But for bonds and gold to be traveling together, it's a very strange combination and implies that the world has something going on that's simply unsustainable. One of those has to be wrong. And so our challenge in managing money for insurance companies is how to deal with the disappearance of nominal yield, let alone real yield, and at the same time control risk, because the temptations to do the wrong thing are increasingly powerful. In fact, in some cases, they're overwhelming. So we see people going out the risk spectrum relative to what they used to be comfortable with. Individual particular clients whose preferences, for whom we've managed money for years, whose preferences we understand pretty well from having known them for some time, are going out the risk spectrum out of desperation, out of desperation simply to continue to try to generate the same net investment income, let alone more, in an environment where their portfolios are running off. The central lesson of government behavior is unintended consequences, and the stronger the government behavior, the greater the likelihood of significant unintended consequences. The expansion of central bank balance sheets has been, obviously, as everybody knows, so great that the likelihood of significant unintended consequences over the next several years are very high. Forecasting exactly what they're going to be, I think you can call them in shape, but the specific locus of them and when they occur is a tougher call. We're still in the development stages of it, but we see some signs of people reaching for return already, and we know how that ends. So our job is to try to manage the conflicting objectives of the near-term demand for return with keeping an eye on the horizon for where the next mistakes are going to be made, because they're already in process.
When it comes to Europe and the crisis there, there's a lot of noise around it. How do you look at that, and where do you see the causes, the implications of, and as well, how do you position your portfolios to mitigate risk of capital loss and ensure that you can have enough real return to keep up with the liability side?
The endemic problem that we have in the developed world is that you had debt buildups in many countries at the same time. So it's not unusual to look over the last few decades at financial episodes. People often look at the Scandinavian episode of the early 1990s and so forth. These breakouts in credit creation happen from time to time. They virtually always end the same way, which is badly. But when they're limited in locale, in extent, or both, they're manageable. The way that the Scandinavian countries got out of it relatively painlessly and apparently fairly skillfully included not only the fact that they managed the situation rather well themselves, but they were doing so in a world that was growing fairly rapidly. When you have everybody in the same trouble at the same time, it's much more difficult to get out of this, and the time horizon is going to be much greater. The stress is so great in Europe because on top of the issues that necessarily follow excessive debt accumulation, they have a deflationary force that other people don't have, and that is a fixed currency regime. So the euro can be thought of as the first experiment in a fixed monetary standard since the gold standard. And we know what happened to the gold standard under stress in the 1930s. It was thrown over the side by different countries at different rates. But as Bernanke himself has written about, the sooner they threw out the gold standard, the sooner they started to recover from the Depression. The same deflationary pressure is at work in Europe now, not only because of the debt buildup, but because when they joined monetary union, they gave up the ability to do what countries invariably do to get out of this problem, which is to devalue. They gave up the ability to do that. And so the stress in Europe is all the greater because of the fixity of monetary union. So how do you get out of that? We have been very skeptical at all of the measures that the European policymakers have taken so far, and remain skeptical. It's very well understood now that monetary union without fiscal union doesn't work. Many people have anticipated for some time that would eventually be a problem. We are now there. The rate at which they move to some sort of joint and several liability, mutualization of risk, both at the fiscal level and in the banking system, is going to determine how that works out, and is going to determine whether the Eurozone ends up as 17 countries, and whether it's the same 17 that we have now. There are theories about whether Greece leaves, how they leave, whether a Greek exit allows Germany to whether that's the quid pro quo to get Germany to the table in terms of joint and several liability, having essentially kicked out the worst actor under the Stability and Growth Pact. So forecasting how this is going to work out, we think, is virtually impossible. But the current situation is unsustainable, and that includes large purchases of bonds by the ECB, because that is a stopgap measure, as is well understood, deals with liquidity but not solvency. Solvency problem remains, as does the underlying problem of differences in unit labor costs. And in some cases, those are still getting worse. So the problem, we are still some distance from the solution. We have thought that as crises develop, they accelerate in speed, and it is felt to us through the middle of this year that was underway. That's what was occurring, and we still think that's true. We think we are closer to what we've referred to as a deflationary thunderclap that has the effect of forcing the policymakers, the Germans being the most important, to do something. And our best guess remains that is the outlook, that pretty soon we're going to get, if the ECB's recent statement about buying bonds notwithstanding, doesn't solve the basic issues. And so if the markets figure that out, and what we're seeing is that these central bank moves in Europe and elsewhere have diminishing returns over time, as the markets figure that out, we may see further pressure on those bond markets, unless they really do something to fix the underlying fiscal issues.